This is the Alhambra Investments Weekly Market Pulse. I'm Bob Williams, and our CEO, Joe Calhoun, is here. And Joe, in your report for this week, I want to focus on what I think is the main topic you talked about. Your title was Inflation Scare. And you looked at the market in March and the market last week, which appear on the surface to be the same, but the reasons for a higher market and what's going on in the bond market are completely different than what we saw earlier in the year.
Yeah, I think that it's important to realize, why are rates rising? Just the fact that the 10-year goes up, I think a lot of people look at that and go, well, growth expectations are going up, but that's not always the case. I suppose you could say nominal growth expectations are rising, but that consists of two pieces. It's real growth and inflation. I don't want to make too much out of this because we saw something similar last time when rates went up. We saw nominal rates go up first and real rates took some time. And I think that kind of makes sense in that, inflation expectations in the short term can change pretty rapidly, whereas growth expectations maybe take a little longer to change or not as volatile, I guess. But the bottom line is this: we've had a rise in nominal rates that has not been matched by a similar rise in real rates, in the TIPS rates. TIPS rates are lagging by a pretty wide margin. So this rise in rates up to the 170 level, which, look, rates are volatile these days. We're, I think, trading down to 163 today, but we did get up to 170 last week. And the peak back in the fall, or excuse me, in the spring was around 175. So we got it right near where that peak was. But it's different. This is mostly about inflation expectations. The move in rates has been mostly about inflation expectations, not about growth. And until we see that change, I think you got to be really, really careful and skeptical about the growth component of what we do. Remember, we look at things within this matrix of growth and economic growth and in the direction of the dollar, which also hasn't changed, by the way. It's still kind of in a short-term uptrend. But that growth piece is about real growth. It's not about nominal growth. The dollar is where we look to for inflation, a guide for inflation, not to the growth aspect. And in this case, we're looking for some real growth to pick up before we really make any commitments to saying that growth is doing better. It's just not there yet.
Well, there was some movement in TIPS last week. Is that because people were afraid of inflation?
Well, yeah. I mean, look, the bottom line is this: when people get afraid of inflation, or listen, when they get fear anything, they're going to do their best to mitigate that fear. Easiest way to mitigate the fear of inflation is to buy TIPS, because it's the thing that's tied to directly to inflation, to the CPI. So yeah, certainly when people are buying TIPS, it's interesting. We had nominal rates went up last week, whereas TIPS rates didn't move up at all. And when you look at that dichotomy there, it just you have to pay attention.
We'll talk about the difference in the yield curve between March and last week.
Yeah, that is a little bit different too. The yield curve is not as steep as it was in March. Another indication that the growth expectations part of what we're looking at is not back up to snuff, back up to where it was. I think there is this expectation building for a growth surge in the fourth quarter. We obviously had a big slowdown in the third quarter, and we'll get the GDP numbers for third quarter this week. And listen, don't be surprised. These numbers could be very, very low, 1%, maybe even less, I suppose. We certainly had a big slowdown in the third quarter, and we saw that, in the bond market. We saw it in the economic stats. I think there are some hints here that maybe that quarter four reacceleration is starting to happen, but they're only hints. We see them mostly in the PMI surveys and some other survey type data that we looked at last week. That seems to be indicating that maybe you're going to get this growth surge, but you got to see it, and it's not happening in the bond market. Is not buying it just yet, put it that way.
In the report, you talked about the break-even rate. Tell me what that is and describe that for me.
Break-even rate is nothing more than just the difference between nominal rates and real rates as measured by TIPS. So it gives you a real-time measure of inflation expectations. So if the nominal rate is at 1.6, say, and the TIPS rate is at -1%, just to make the math easy, that would mean that inflation expectations are 2.6%. That's all it is. And we look at that across the curve too. We don't just look at the 10-year. That's the one I usually report when I write these things, because I tend to focus on long term. But we look at 5-year and 10-year as well. And the 5-year, actually, inflation expectations at the 5-year level are actually gone up faster than they have for the 10-year. That's one of the interesting things that's going on here. And one of the things I wrote about is, the idea that inflation is transitory. The market actually bears that out because the 5-year inflation expectation is higher than the 10. And what's more interesting, I think, is that we look at what's called the 5-year forward. Man, economics comes up with all these strange little things. But what the 5-year forward is it looks at inflation 5 years out, starting 5 years hence. So it's looking at what inflation is going to be between 2026 and 2031, if you can think that anybody has any clue what's going to happen then. But that number is actually lower and has been falling. And is very well controlled at 2.4, basically. So it's interesting how the market is saying, look, transitory. Yes, it is transitory. I'm not sure that's the Fed's definition of transitory. I think the Fed's thinking more like a year or so, and the market may be looking out further than that. So that's kind of interesting to me.
Do investors get confused between short-term growth and long-term growth?
Yeah, I mean, I think so. And I think a lot of times that comes up when we talk about the difference between the way I see things today and the way Jeff sees things. Jeff's always focused on the long term, whereas I have to spend a little more time on the short term. And short term is not what most people think it is. Short term to me, it could be a year or two. Long term is 5 or 10 years. So when I say short term, I'm talking, yeah, it's still a significant period of time, 6 months, 12 months, 18 months, something like that. Look, our expectation is that long-term growth, the long-term trend, is going to be somewhat less than what it was going into COVID. Going into COVID, we were growing at 2.2% for the previous decade on average. We added a lot of debt during COVID. We didn't do anything during COVID, at least not yet anyway. We don't know for sure yet. We don't think we've done anything that would affect productivity growth. And certainly nothing positive has happened in to the workforce. We've had participation rate is low and it stayed there. So unless we see a change in those things that directly affect growth, which is workforce growth and productivity growth, unless we see a change there, then what we've done is take an economy that was growing at 2.2%, added a whole bunch of debt to it. I can't imagine that you're going to do that and come out the other side growing faster. You're going to come out growing slower. So our expectation is that long-term, after everything settles out, after COVID either is endemic and people are living with it or whatever the case may be, and all the responses to it have faded, we're going to be growing at something less than 2.2. But that's an assumption that is based on no big changes in productivity or workforce. I'm not sure those are good assumptions. We're going to have to wait and see. But over the next 6 to 12 months, I think, you got to look at are we going to get this reacceleration from the Delta fading, or are we going to get another, Delta, +1? I don't know. Or are things going to continue to slow? And are we already back to that long-term trend growth rate? Maybe we're already there. Maybe we don't get any more, big surge coming out of COVID. Maybe that's as good as it's going to get. I don't know the answer to that yet. We're going to wait and see. I think that the labor market's going to be really key here. We've got some very strange things going on in the labor market. We're going to see if a lot of those people that were on benefits that ended in September, are they going to come back in the workforce? We're going to find all those things out over the next couple of months. So we're going to get a lot of information about short-term, near-term growth over the next few months, and we'll see where it goes. We'll go where the market leads us, put it that way.